Welcome to TheoTrade. This is Don Kaufman. It's June 9th, 2018. You are watching the Theo Weekend Update. Let's get right to it. We're going to do a quick review of the previous week, some of the action, some of the trades that we had on, and then we're going to jump right into this coming week. And the reason I say that, oh people, this next week, it is just chock full of binary events. We'll kind of qualify that statement as we go. What I want to start with on this weekend's update has everything to do with a comparison of the Nasdaq, the IWM, okay, and of course the spiders. Now, these are color represented. The spiders right down here, down below, right in the middle of your screen over here happens to be that's the IWM, and last but definitely not least are the Qs. So again, we're looking Nasdaq, Russell, and S&Ps. Now, why am I showing once again a comparison? Well, to start off an explanation of this past week, we have what we call kind of correlation breakdown. Now we realize, okay, you realize that the Nasdaq, okay, is pretty much sitting at all-time highs. The Russell is effectively sitting at all-time highs. The S&Ps, though, still have quite a ways to go to be anywhere near an all-time high. But one of the things that you want to think about from this past week and moving forward is, again, what I term correlation kind of breakdown. For that, we're going to cruise over here to the Market Watch. And when I talk about correlation breakdown, it means a tremendous amount. So what you're looking at right now is the S&P 100. Okay, in the S&P 100, what is this correlation? So some people look at like the advanced decline line on an intraday basis to kind of get a feel like, oh, well, what's going on? Well, you know, in many of the recent weeks, since the markets sold off hard in early February, we've been in these bouts of volatility. Let me take you back over to the chart for just a second to kind of reiterate this point a little bit. And for this, we'll in fact pull up the spiders, because it's really one of the most important points to be made in this entire last week of trade. So given this volatility, there's more volatility moving forward. Okay, great. Something changed right here, and it's literally this week. Okay, what changed? Well, what changed is the markets are less correlated. What less correlated effectively means is, you know, when you look at the advanced decline line on a day-to-day basis, just from this past week, it's been a veritable slop fest. What a slop fest kind of means to me is, you know, you're having days, literally having days where there's 50 products up, 50 products down in the S&P 100, but the market is actually grinding higher. Why? Well, because of some of the big tech stocks. Now, the advanced decline line, okay, all of a sudden means very, very little. And that big market cap is actually pushing us forward. Now, what it tells me when the correlations kind of break down, and again, let's define a little bit more about correlations. In the previous weeks and months when we were heavily correlated, we were seeing on a day-to-day basis, for example, 85 products up, 15 products down, and vice versa. Didn't matter. If the day was up, there were 85 products following suit. If the day was down, there'd be 85 products versus 15. Okay, and that's high correlation. In fact, in a lot of recent volatility, okay, to the upside or to the downside, and a lot of the recent volatility, we've actually seen literally 95 products on one side of it. And one of the most unique things that we've seen again in this last week is that those heavy correlations have actually broken, which as a trader, now you got to be, okay, very, I would say, underlying specific. This is where, as a trader, I have to actually deviate. By the way, I grew up around index trading, but for me, I have to start to deviate from where I'm comfortable. And where am I comfortable? I'm comfortable in the Nasdaq, and I'm comfortable in the Qs, and I'm comfortable in major indices like the SPX. All of a sudden now, I'm having to shift towards equity products, or for example, something like emerging markets. Interesting irony is we've had a lot of success in the emerging market product. Nevertheless, you have to kind of go out and like snipe individual positions, okay? And at this point with this correlation breakdown, until we see otherwise, okay, I start to worry a little bit less about the major index product. And at this point, I'm actually much more worried about the sectors, okay? Why am I looking at the sectors? Because the sectors are what causing some of this correlation breakdown. Again, it's one of the most important points that I can make, and I need to stress this to you one last time. With this correlation breakdown, what effectively means you know, you can have a day or two where the financials, okay, are ripping higher, and at the exact same time, the Nasdaq is actually headed lower. So it's capital rotation. Some people think of this, you know, as like it's almost like a shell game. They're like, everybody get into the financials, everybody get out of technology. And that's precisely what we saw as the week progressed. Look no further than, again, the Nasdaq starts to fade later in the week. And again, here's later in the week, the Nasdaq starts to fade. Yeah, where's that money going? Oh, let's move into the financials. This is, you know, Fund Manager Shell Game 101. And a lot of this, and by the way, I'm going to be very frank, it's not the kind of trade that I love, but you got to get into it. Okay, it's sector rotation, and you got to basically pick out, you know, what's the next sector that's going to fall? You know, what's the next sector that's going to rally, and try to get a step ahead of it. And that's exactly what we're going to do. So it's one of the most important points to be made is that start looking sector by sector, or even, okay, equity position by equity position, right? And that's what you want to focus on, and focus a little bit less on the major indices. Speaking of the major indices, and this is only really, you know, one of the last times I'm going to mention it in this video, because again, I'm going to be much more specific into some of the sectors. The SPX last week had right around a $33 expected move. And people, it exceeded it. That's kind of what that shaded region means, the really bright shaded region. It slightly exceeded the expected move to the upside. Now, nothing crazy, nothing too unusual. We had, you know, to the upside again just a few weeks ago. And, you know, I've said this week in and week out, but you have to kind of almost redefine what you have classically been taught about volatility. I know I have, for one. And when I say that, I'm not like, oh, you need to refine volatility. Listen, we're having markets that are having volatility to the upside. And there's a very good opportunity in that. And you know why? Well, because the volatility, if you know, according to the VIX, is down at 12. But you know, if you look at the actual price movement going on inside of the SPX, it's still huge. It's absolutely huge. This is truly like some volatility to the upside. And that sounds like, you know, it's like an oxymoron, volatility to the upside. But it is. That's exactly what it is. And I start to step back from the marketplace, and you realize that in this marketplace, you know, what's changed in the last couple of years? They're like, algorithms. Nobody told them that volatility is only to the downside. Apparently, they can have volatility to the upside as well. So it's something to absolutely kind of think about in your trading. And to see this kind of volatility to the upside, and why do I call it volatility to the upside? I don't know. This is 2 weeks of trade. This is exactly, and if I zoom in onto this, you know, this area right here is exactly 2 weeks of trade, and it's taking us all the way from, you know, I'll just come to the bottom over here, is, you know, 2690 to effectively, you know, 2780-ish. It's just, if you want to include this little, you know, the candle in here, but it's literally, it's 100 S&P points in exactly 2 weeks of trade. By the way, one of these is a shortened week. So you have 9 trading days and 100 S&P points later. That, people, is a bit of a rally. But the interesting part of that, where I don't think a lot of people are quantifying it well enough, is, you know, in a 2-week time frame, you know, how much are we supposed to move? Well, I just said in a 1-week time frame, it's supposed to move about 33 bucks. But even when you start going out, you know, like some 16 or even 18 days, you know, $55 a movement, $60 a movement, nothing says we're supposed to be moving what? You know, 100 points. Look at this. You have to go out 44 days, okay, or 41 days, I should say, just to find a 100-point move. Now, that just reeks of volatility. I mean, that's what it's about. It's about exceeding the expected move. The options market is getting, okay, the options market is getting it wrong. That's a huge takeaway. And it still says that we are on the buy side of options on an intraday and week-to-week basis. We still think that there's some premium to be sold far out in time, but on a day-to-day and a week-to-week basis, we're on the buy side of premium. All right, so we talked a little bit about correlation breakdown, and we're going to get very specific on that front, okay, as we kind of move forward. Now, speaking of moving forward, with the SPX, okay, this next week in the SPX, and what's more important than just looking at the chart would be looking specifically at the implied volatilities. This next week, we're portraying about a 35, let's just call it a $36 expected move. Now, here's something that is interesting. Why? The last few weeks of trade, okay, we've seen right around a $33 expected move. Even in the holiday week, right? We had about a $33 expected move. But all of a sudden, seemingly out of nowhere, we have a almost $6 expected move. So you have to ask yourself, why is the expected move larger? Okay? And to me, there's a fairly straightforward answer. But the one thing I want you to recognize, the market is rallying, okay? It is rallying, but this expected move here, which is about $36, is actually larger. This $36 move, higher or lower, this is larger than the previous 3 to 4 weeks. Okay, and there's really only one answer to it. It's, when the market goes up, volatility typically contracts. But in this case, the market's going up and volatility actually expanded in this next week. And it has to do with the fact that, well, this next week, it is just chock full of events. It's just chock full of binary events. And I made that statement a little bit earlier and oh, what does that mean? I don't even know where to begin. I mean, this week, so we have a G7 summit going on this weekend. That's pure turmoil. Throw it aside. Okay, there's the North Korea meeting going on. There's no, definitive outcome. Okay, throw it aside. We have Wednesday. We have the FOMC meeting on Wednesday. They're probably going to raise rates. That's pretty much packed in there. Great, throw it aside. Wait, there's more. Then we have the Bank of Japan that evening. So if the Fed wasn't enough for you on Wednesday, then you got Bank of Japan. You don't think that matters? You better believe the Bank of Japan matters. Why? Because if they actually showed that they're going to pull some of their stimulus, it is on, people. Bank of Japan this week means a lot. To throw that in there and to counter it, here's another really big one, the ECB. ECB comes out Thursday morning. Why is this important? Because they may actually further give statements contracting their bond buying program, which initially everybody would be like, yeah, we're getting out of quantitative easing. And then everybody goes, this is not good. We're getting out of quantitative easing. There are so many binary events. Just throw your hands up in the air and submit at this point. Okay, this is the kind of week when I start looking at the S&Ps, and I want to be very frank with you. All the levels, okay, and what you think, put it all aside. This is a binary type of week. Now, it actually makes sense when I say a binary type of week. The entire S&P, okay, is just a series of coin flips. We're just going to go through and be like, bing, G7, heads. Okay, we're going to rally a little bit. Bing, North Korea. Oh, it didn't go so well. It's a little bit more bearish. And the market's going to be just absorbing blow after blow after blow. That's where I'm actually going to tell you deviate from it. I think it makes sense that there's correlation breakdown right now. There's not a lot of people that want to place any really large bets in the S&Ps. They don't really want to, place big bets inside of the Nasdaq. Okay, what they're doing though is they're going after individual sector type positions, and that's exactly what we're doing as well. I'll give you a couple of them. When you start to look at individual sectors, and again, think about all these different binary events, the XLF really comes to mind. And the XLF, interestingly, okay, look at the 6-day volatility in here. Forget about what you think. Okay, it doesn't matter. Let's just look at what that volatility happens to be. It's about 21% for the next 6 days. Just to show you what's at risk this week, 21%. You're like, whatever, man. I don't even know what that means. Well, you can compare that, okay, directly to the Nasdaq. So why am I comparing, the XLF to the Nasdaq? Why am I comparing financials to the Nasdaq? Because the financials actually have a substantially higher volatility than does the Nasdaq this week. That's a little bit strange. You should always key into stuff like this because the financials, these are what hold the key to the S&Ps. All right, the financials are driving a lot of the S&P trade. And lately, if you haven't looked at this, the financials, they are massively unchanged on the year. Look at this. This is the lagging of the major kind of, components of the S&P. It's literally unchanged on the entire year. and they're sitting with highly elevated volatility, which should make you a little bit nervous in terms of either direction. Again, binary events are neither bullish nor bearish. They're coin flips that are coming, but you can see the elevation in volatility because of the Bank of Japan, because of the G7, okay, because of, ECB. All of these are going to impact the financials specifically. All right, moving on from there, okay? So this week, the financials are going to be in play and in play in a big way. In fact, even on an intraday basis, I'll be looking to take some trades possibly inside of these financials. Speaking of the financials, they've been kind of lagging. A lot of questions about, Morgan Stanley. I am still in and will maintain my short position inside of Morgan Stanley, right? I've got a long duration short position, okay, built in multiple expirations inside of Morgan Stanley, and I will remain in that short position. If you look at Morgan Stanley, again, on a year-to-date basis, it's actually now underperforming the XLF. And I am aware, because there's binary, trades coming out this week, I'm aware that this thing could actually pick back up. But longer duration, I want to make this clear in Morgan Stanley, longer duration, I'm still absolutely bearish in there. Okay, let's spin things around for just a second. We went into XLF and we're talking about some of the volatility. We jumped over to Morgan Stanley because it was one of the financials. Now let's look at the emerging markets. In the emerging markets, listen, we have had a lot of trades in the emerging markets. We've been bullish, we've been bearish, we've been bullish, we've been bearish. We were bullish and then we flipped over and we're bearish again. Okay, if you haven't caught up, literally it was last week we had a bullish trade on. We exited the bullish trade for near full profitability. We then turned around, flipped the position over, put on a bearish position, and we pulled it off on Friday. We pulled that position off on Friday, okay, for a nice approximately 35 to 40% gain on the in-out spread. We are now out of it. And what was important about that, not everybody may be out of it, but the emerging markets sold off early in the day. We exited this position, kind of rallied back up to unchanged. Nevertheless, I currently, have no positions in emerging markets and will continue to kind of fish for new positions in emerging markets. This is something that, again, when I look at the EEM, when I look at bonds, all right, everybody's kind of circling the wagon, meaning that, and I've talked about this in previous videos, they're all circling the wagon. It effectively means to me that everywhere you look in the marketplace, there seems to be volatility other than the S&Ps themselves, right? And that volatility really kicks off. The emerging markets are really volatile. You look at something like Brazil, you look at the bonds, you look at the dollar, okay? I mean, I can go on and on and on of all the different products that are displaying high degrees of volatility, but it still hasn't, the S&Ps just have not succumbed to that. And it's something to, I think to keep in mind. Nevertheless, because the volatility isn't, for me, like it's not great inside of the S&Ps, I don't care. I just deviate to the next, best product. And to me, I like the emerging markets. And if you've never looked at this position, I don't want to, prop up a product, but come on, look at the volume in here. Look at the volume. You know what? Apparently, a lot of other traders agree. Because the volume inside the emerging markets ETF, that's 361,000 contracts. Not a whole lot of ETFs doing that. Go look at the Qs. I just want to show you in contrast of like, why am I looking at the emerging markets? I don't know. I'm a trader. I'm equal opportunity trader, but you're realizing like emerging markets are trading the kind of volume that you'll only see in something like the Qs or the spiders. That's how big the emerging markets have kind of become because it's an ETF with a whole heck of a lot of volatility out there. All right, so completely switching gears, one last thing I want to leave you with, and this is something that you can look at and try to execute throughout the course of this week. I got to come over to retail. So again, I told you I was going to be very, I'm going to be very specific to different sectors inside of the S&P and retail. This one absolutely screams. So what specifically is, the retail sector? Like, what is it screaming to me? Well, that's the whole key. Take a look on a year-to-date percentage and you start to realize like the retail apocalypse apparently is over because the retail, and again, this is the ETF for retail, is up some almost 8% on a year-to-date basis. Now, I just want to throw this at you because when you start looking even at the Nasdaq, okay, just compare it to the Nasdaq, because that's how hot retail has been. Retail has to be compared to something like the Nasdaq. all right, because the S&Ps are well behind it. But anyway, the idea that I see inside of retail is I'm going to look for a short position. But the more that I looked into retail, listen, I don't have any love for the XRT. I just don't have any love for it because it only traded some 7,000 contracts, and it's up by amount of, of 7%. But the XRT is kind of like, to me, like the XLF. Yeah, it's really good, but I want to find, an individual product inside of retail that I'm going to go after. And in that case, I brought up a bunch of different products. I don't want to go through the entire methodology, but I went up through a bunch of different products. And the product that outperformed the most was clearly Macy's. On the retail side, yes, this is a year to date. You have to just, behold. All right. So this is literally, when you start to bring it up and you just click year to date and you're like, okay, there's Macy's year to date. It's up 50%. Is it a topping formation? Quite possibly. No idea. But I am willing to actually stake some capital at it. And I've been putting on and kind of fishing around in a couple of bearish positions. Now, I have not executed, at this point, but, a handful of contracts in this case. So you can see that I've got on at this point, like 2 contracts. I will be fishing for more contracts, as we kind of move forward in here. And it's interesting because if you're looking at the volume and open interest, for some reason, it doesn't look like they updated the open interest yet because there's 80 contracts plus the traded on here. This is a bearish, again, it's a bearish in-out vertical spread. It's trading right around $1. It's a bearish in-out vertical spread. What we're effectively trying to do is fade the move to the upside. And we're going to look to do this in a couple of different areas inside of retail. When I say fade the move, it's just like it sounds. I'm looking for Macy's, not necessarily to tank. Listen, all I need is this thing to come off mildly. And I say come off mildly, I just need, Macy's to come down. And this is a position, once again, that I'll talk about in much more extent throughout the course of this week at TheoTrade. All right, there's a lot to think about on this weekend's kind of update. One of the primary kind of takeaways, all right, number 1, you have a week that's binary event after binary event. So it's chock full of risk, chock full of events, right? It's a bunch of coin flips. Number 2, there's been correlation breakdown. And that correlation breakdown, go back to this on a day-to-day basis. If you're kind of curious, right? Is this going to go back to 90, on one side? Even if it's bullish or bearish. Like, are we going to see like heavy correlations again? If you start to see heavy correlations, that implies, that volatility is either back and or right around the corner. Those really are the 2 big takeaways from kind of this previous week of trade. Right now, we're going out, we're trading individual equity products. We're trading some of the sectors inside of the S&Ps, and we're going to look and continue to look for correlation to grip hold of this market once again, to give us some opportunities in the major indices. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.